Welcome to the weekly update, where I'll go over the action in the market for the week of March 18th through the 22nd, and then we'll see how things look for the week of March 25th through the 29th. We had a really solid up week. We saw a pivot from the Fed. They're going into more of a dovish stance. Jerome Powell did not really say anything new in his press conference. They didn't change interest rates right now, but they're kind of changing their whole overall tone, and the market is taking that as positive. We saw a real up move in Wednesday's session, and then also in Thursday's session. Saw a little bit of a pullback in Friday's session. But when we look at the bigger picture, we are looking positive right now. Of course, we're overextended, and we could be coming into a period of weak seasonality. But I've been saying that now for quite a while. We have to follow price. Price is the ultimate indicator. We can come up with all kinds of logic ourselves as to why something should go up or down, but it comes down to following the charts because there's stock market logic, which often goes against human logic. Before I get started, please view the daily videos for daily commentary and analysis. I've taken out the daily things that I covered in the weekly video, and I'm now to try to make this video shorter or not any longer than it's already become. So please check those out. I think you'll find that more helpful. My personal opinion is the weekly videos, they're nice and they give us a big picture look. But if you want to really hone in on what's happening, looking intraday there's too much noise that happens there. Weekly, it's nice to know, but that's too slow personally. It comes from a day-by-day evaluation of the markets. Sometimes things don't change, but we see an ever-evolving story that becomes clearer and clearer as we analyze things. That's where I come out. Also, this past week, I did a video that's available on my YouTube and Rumble channel that talks about the program that I'm hoping to launch in June. Now, I'm going to be releasing more videos that go more in depth about that. So after this video, I'll probably put up another one in the upcoming week just to explain a little bit more. I'll create a playlist on the YouTube channel where I can do that. And if you come at a later time, you can just marathon through these to kind of get an overall view of my philosophy, what I'm trying to do, what things I really cover. Also, a PDF is available in the description below every video that I post. Also, I've started a new video in 2024. So far, it's been just once a week. And it's called a What to Watch video, where I do the daily videos. I do this video, the weekly video. After this, I'll do an intermarket analysis video. And then I'll do a deep dive video where I go through the charts that I really don't talk about all that much. Then I take all of those things together and I say, okay, what am I focused on right now? And I come up with a list of positive things and a list of negative things. And that's what I'm really keying in on at this time. I think this is what's really speaking to us right now. Then the idea has been that if I need to do an update of this, I will do updates on an as needed basis, but I really haven't needed to do that. So right now it's kind of settling into a weekly video. If things really shift, then I'll do an updated video. I do post the pivot points. These are daily and intraday support and resistance levels that on the daily charts, they calculate for the month. On the intraday chart, they recalculate every day. And these are very significant. A lot of the algorithms that are used out there for program trading, they base themselves around these pivot points, and these act as support or resistance. I update those charts every day on the community tab. I do have a private Facebook group, not really active in that group. I might be gravitating towards something else as I get ready to launch the program. If you have any ideas, I'd love to get some feedback as to what might be more effective, not just necessarily for you, but what would be more appealing to most people that are involved in the program. I do have a poll that I'll be posting for the upcoming week. I had some trouble posting it this past week. I could post the question, I just couldn't post the answers. And I tried posting that 4 times and it never did really take. I'll be going over those results though of the latest poll in just a moment. And then I really watch the YouTube and Rumble comments very closely. If it's crap comments, if it's garbage, if it's somebody trying to promote something, I delete those comments. I want a true back and forth. I don't get a lot of comments on my videos, and that's okay. And some of you decide to contact me by email. And at the very end of this video, I'll give you an email address. Do what is most comfortable to you. Then I also post on not only YouTube, but Rumble, and down here at the very bottom, this is the link. This is also posted in the description. Let's go back and talk about what happened this week. For the week, we were up 2.29%. Now, that pretty much came from Wednesday and Thursday sessions. We weren't really up all that strong on a daily basis, but when you take everything together, things ended up being quite positive. We were below average with volume. Now, some people kind of throw volume off. They say it's not that big of a deal. The general textbook rule that I've tried to follow over the decades of watching this is whatever move you see, if it's on below average volume, that lacks conviction. But we're hitting all-time highs. And a lot of people are trying to ride this thing out, and they may not necessarily be adding to new positions. So they may not be doing a lot of buying, and they're riding into it, so they're not doing a lot of selling. We are positive with our technicals, and we're looking rather extreme. There's always some things to worry about. It's about inflation and interest rates, and that saw a real shift this past week, where the Fed is really changing their stance. They could look at lowering interest rates maybe in June, and after the meeting, based on a report that they do, it's looking at them like they may do 3 rate cuts in 2024. Now, that can always change. We had CPI and PPI come out week before last, and that came in pretty hot. If we start seeing real strength in these economic reports, that could throw this whole scenario into jeopardy. That's why I go through the economic reports that are released in the daily videos. Our trend is still positive. We are strengthening. We're looking really solid with the longer term trend, and it's positive with the green line on top, and it's getting stronger. On the daily charts, we're weakening out. We spent a lot of time going sideways, where we're just kind of chopping around right now. That shows a weakening trend. However, we are still trending, and we're positive in the short, intermediate, and long term on the daily charts, and we're also positive here on the weekly charts. So for the week, the Dow was up 2%, the NASDAQ was up 2.9%, the S&P was up 2.3%, and even the Russell, okay, that's not right. It wasn't up 46.7%. It was, we'll just get to the chart and look at it there. This is obviously a mistake. All right, just some bullet points to take away from this. The stock market had a strong week with the S&P closing above 5,200 for the first time. Some folks were seeing that as a target to the upside, and then we would hit that and start to come back down. Well, we haven't done that yet. It still may develop into that, but so far we've been going above 5,200 and setting all-time highs. And the main indexes with the S&P, the Dow, the NASDAQ 100, they're either setting all-time highs or close to all-time highs. The mid caps are also close. They've been pretty strong lately. It's the small caps that are really lagging behind, except looking at this previous chart, up 46.7%. Yeah, right. Okay. Then the FOMC did leave interest rates unchanged, but their summary of economic projections, or SEP, it does anticipate 3 rate cuts this year. That was one of the things that the market really latched onto. Another thing that some folks are thinking that Chairperson Powell hinted at was to stop doing quantitative tapering. This was quantitative easing that happened during the lockdowns, when the Fed came in and just bought all kinds of bonds to try to add liquidity to the market, to keep interest rates down. They shut them all the way down to zero. That fueled the interest rates going down. Some of that money came over to the stock market with the stimulus checks and all that stuff, and really shot the market higher in 2021. Then we started to reap the inflation that kind of an event can happen. And so in June of 2022, the Fed came out and said, we're not going to buy anymore. We're going to just buy these bonds, and when these bonds mature, we're just going to let them drop off our balance sheet. We're not going to replace them with any more bonds. Well, this past week, there may have been some hints that they're going to entertain the idea of possibly going back in and purchasing. Now, they haven't officially said that. You kind of have to look deeper to get to that conclusion. So we don't really know. There's some speculation behind that right now. But if that ends up happening, that could help keep interest rates lower, have more liquidity in the US economy, also filtering into the stock market. You also have an anticipation that GDP is still going to be pretty strong, where we're shifting over more technologically. Companies seem to be looking pretty good as far as earnings and looking out into the future. You put all of that together and it has a pretty positive backdrop. Doesn't mean we're going to go straight up. We're going to have periods of declines and pullbacks, and even to the point where we might start to doubt this more positive scenario. But as things look right now, the market is looking fairly healthy, even though you may be suffering economically with gas prices and food prices and all of that. There's a real disconnect between the financial markets and the average person right now. Fed Chair Powell's press conference, it was taken as dovish. He really didn't say anything new, but he didn't say anything really hawkish. And so the market took that as good news. Interest rates ended up falling. We came down to 4.22%, and the US dollar was up. It's been bouncing a little bit. They raised interest rates in Japan for the first time in a long time, and that's pressuring the yen has really been under weakness. Now, you would think when interest rates go up in Japan, that would give the yen some support because it costs more to borrow more yen. But they've been having some issues there. And when you compare the dollar with other indexes or other currencies like the euro and the British pound and the Japanese yen, the dollar is seeing a bit of a rebound currently. Mega caps, these are the big Magnificent Seven stocks. They outperformed this past week while the small caps really lagged behind. This is a chart that I've been showing, and somebody tried to post a similar chart to this on Twitter where it's more updated. We're still in this downward phase if you see the cursor here on the screen. And they just posted an updated version of this where you're trying to compare 1966 to 1982. We don't know if it's going to play out this way, but if it does, and we go through this lessening of inflation, look at what happens after that. And the person that posted it just got lambasted, called stupid. And it's like, come on, just look at the information. You can choose to accept this as some kind of a guide and just be aware of it, or the scenario will play out different and this chart will no longer be relevant. That's kind of where I come out. Then we did fall down to 4.22% with the 10-year yield. We're still above the 4.02%. So this is biting in somewhat to corporate profits. Here are the poll results. And here's the question. I got the question posted. And I tried to look at this in different ways, and sometimes the answer showed up. Most of the time it didn't. So all I could do was take a screenshot of the question itself. As of Friday's close a week ago, the S&P remains above long-term resistance at 5110 to 5111. Do you feel that we're going to stay above it or go below it? Well, you can kind of guess now. We're well above that. We're into the 5200 range. So we're above that longer-term resistance. And I will show you a chart of this. Small caps continue to lag, and they're still lagging as of right now. Do you feel that this will have a positive or negative, or that they'll have a positive or negative week? It was split 50-50. They were up 46.7% according to this chart that we saw. So anyway, we'll look at the small caps here in a little bit. Do you feel that stocks will follow the historical seasonal weakness or continue to deviate from these historical averages? We really haven't latched on to what has historically happened in March. We see a nice little bump up at the beginning of the month, and then we tend to see some weakness. And now at the latter part of the month, because we're ending a quarter, that's when we see a little bit of a bump up going into April. We just haven't really been sticking to that. And 67% said that we're going to deviate from these patterns. And that's kind of the right choice right now. We still want to know they're there. We still want to respect them, but we can't necessarily base our decisions around that. We just use that as a guide. Interest rates have been rising, which is now pressuring stocks. This was a week ago. In the coming week, do you feel that interest rates will continue to go up or they'll decline? 86% said that interest rates are going to go up. Well, we ended up coming down. And so those of you in the 14% category ended up being correct. All right, here's the weekly look at earnings going forward, whether you're Morgan Stanley or the consensus. These are still going up, and that's justifying higher stock prices. Then Carson comes out with this chart, and you can't even read this little area. So I blow it all up, and even though it's fuzzy here, I hope it's a little better to read. They're just saying S&P performance after 118 or more new 52-week highs using first signal in 6 months. What happens after that? Well, a month out, we're up 76.9% of the time. The same thing 3 months out. So we're still looking positive going forward. When you go out further, the percentage is even higher. And a year from now, it's 100% higher. Then what is Goldman Sachs thinking will happen? Well, we've already hit their target level for the whole year. And now, so they think we're going to come down from where we're at right now and end up finishing the year at 5,200. Okay. And then this is looking at tech. It equals bull leadership since the great financial crisis. This is similar to some of the other studies that I do in this video, and I do them a lot heavier in the intermarket analysis video. This is comparing the tech sector with the S&P 500. When we go above, when we're going up, that means that the tech sector is outperforming. And that's what's happening here. Not really a surprise, but we're getting to kind of an extreme reading where other times this really topped out. And so folks are a little bit concerned that maybe this is going up a little too far. Then the euphoria meter. This is when you take the S&P, that's the black line, and then the euphoria meter itself, and it's high, but it's not necessarily as high as what it's been before. Then looking at the largest inflow to gold since May of 2023. It's like, okay, that's less than a year ago. I don't get into this since 2016, since 2021, because you have to look at the context of what was happening at that time. To say that it's the same level that it was back, to me, that's a useless comparison, but it's easy for the financial media to do that. We're looking at the raw flows going into gold because it's breaking out, even though it was down on the week and it's been underperforming the S&P. Then we look at the 4-week moving average, which is starting to go up as well. Then government debt. And at some point, is this going to become a problem? Doesn't seem to concern too much of the government now. Okay, and it's just going all the way up. Yeah. And this is a chart I have been showing where if the Fed can do what it looks like they're going to do, this could be positive for stocks. If they could slowly cut rates and adjust it for what's happening economically. The big variable is something terrible going to happen? A war, an attack, some kind of I don't know, a global pandemic. Like that's really going to happen. Yeah, but if something like that happens, then the Fed's cutting interest rates for a different reason, and that puts stocks under pressure. We did have a couple of posts from FactSet. Where are analysts most optimistic on their ratings for the S&P 500 companies? Because we're ending the first quarter of 2024. Now we're going into the second quarter, and I have some gobbledygook to read here. Overall, there are 11,557 ratings on stocks in the S&P. Of these, 53.8% are buy ratings, 40.5 are hold ratings. I don't put a lot of stock into this, but some people do. And in my class, I talk about the uselessness of analyst ratings. Because if you want to have your emails returned, if you want to call somebody up and actually get some answers, and you're going to rag on the company and just say bad things about them, well, you're not going to get any more information. So you have to butter them up. You got to schmooze them a little bit. And so really a 40.5, that's as good as a sell signal. And then the stocks that are completely falling apart, 5.7%, they are actual sell ratings. And this is measuring the price right here. And this is measuring the buy ratings that are starting to go back up right now. Then there are other posts that was posted later in the week. Industry analysts project 7% increase in the S&P over the next 12 months. They think we're still going up from here. Now, we have a couple of down days or a down week or so, and this is going to all change, but it's like join the party while it's going on for right now. Here's our intraday chart. In Monday's session, pretty quiet. And then we ended up gapping lower and then coming back in Tuesday's session. That was actually more positive to gap down and then close at the high. And then Wednesday was really quiet. And then here's where the press conference happened. They liked what they heard. There was some gyration, but we skyrocketed up. Then everybody got home from work, read the news, and said, okay, I'm going to buy. We ended up gapping higher in Thursday session, and then we just drifted. We actually, when you take the open to close here, that was actually a negative day. We saw all of the advance just in the gap higher opening. And we drifted down a little bit in Friday's session, and then we tried to go positive and then ended up closing just about down here at S1. So we're not seeing an awful lot of intraday action right now. It was initial reaction to what Chairperson Powell said, then the hangover reaction as well. And then there were no economic reports, so there wasn't really a lot to hang on to on Friday. So for the week, all of the indexes ended up being up. This is just the 5 trading days where we had the mid caps, which have been showing some real strength, especially since the end of January. They came in the best this week. I guess the small caps were up 2.27%, not 46.7%. The NASDAQ 100, the Dow, the S&P, and then the NYSE. So everything was up. When we go back to the beginning of the year, the small caps are just barely positive now. We have the NASDAQ 100, and S&P doing the best because there's a lot of overlap in these indexes. A lot of the NASDAQ 100 stocks are also in the S&P 500. Looking at our sectors, we had an up week, so I sort this from strongest to weak. The communications sector, industrials is another area. This is one of those areas that tends to do better when things are looking a little better economically. They were up pretty strong, and they're looking a little more solid. Discretionary by itself is doing okay, but it's not necessarily outperforming staples right now, because staples is going up also. And then we have tech that was up. The financial sector continues to look pretty good. Energy's been bouncing back up right now. The one sector that was down was real estate. Now that could show some improvement. If we do start to see interest rates going down, that could make getting a mortgage less expensive in the long run, and that could really help the real estate sector. Then looking at the scooter score over on the right-hand side, this rates it on a scale of 0 to 100. The higher the score, the better looking that sector. Industrials are now in first place, followed by communication and tech. Communication and tech have been there. They've been the stronger areas. The financials showing some improvement. We're still wondering, is there going to be other shoes to drop as far as regional banks that run into some problems? Hasn't developed to this point. And then some of the weaker areas are staples, even though they are in an uptrend, the real estate sector and utilities. These are the more defensive areas that don't do as well in this type of an environment. Looking at our relative rotation graph, this breaks down the 11 S&P 500 sectors where we have communication looking stronger. The financials, they've weakened a little bit, but they have been a stronger area. Also tech showing a little bit of weakness here. The industrials, this is what's showing some strength right now. And then over here you have energy, which was showing some strength there for a while, but now could possibly be pulling back. Utilities have been weak, and real estate has also been weak. Then this is looking at the indexes compared to the new version of the Wilshire 5000, showing that the NASDAQ 100 is doing the best over the last year, followed by the S&P 100 and then the S&P 500. The other indexes that are showing more weakness are all of these, rather than just reading through. Just look at the 3 strong ones. If your index is not there, it's one in one of these red areas. And looking at the different sectors, where we had industrials, discretionary, and technology, they were up the most over the week. Discretionary had a pretty good week. It's just not really outperforming staples. And we did have a number of sectors that ended up being down just for the 5 trading days. Going back to the beginning of the year, we have communication, tech, and industrials now doing the best. Discretionary, which is way down here, the dark blue, it had been one of the 3 stronger areas. It's now being replaced by the industrials. Looking at sentiment, this actually, it got up to 75, and then we had a bit of a decline in Friday session, so it came down to 72. We're starting to get a little extreme. We did tick up here. Now, we can go back up, and we can camp up here for a while, but when we get above 75, that's we ride this while it's going in one direction or the other, either up or down. We can go with that. When we start to get to 75 or above, that's when it's like, okay, everybody feels this way. And that's usually when we see something happen. It could be a decline, it could be a pullback. We could even see a consolidation that goes sideways. So we just want to be aware of this. Looking at the active asset managers, they were really, really positive a week ago. They've come down, but they're still really positive right now. When we get above this red line, that's where we start to use this as a contrarian indicator as well. We can ride it when it's going up and ride it when it's going down. But when we get above this red line or below this blue line, that's when we start looking at some kind of a contrarian viewpoint. Here's another look at that same chart coming in at 93.22, where it is down from the previous week, but still giving us quite a high reading. Looking at the VIX, we finally broke this on the daily chart. I actually have a line drawn here. We've been seeing the VIX going up since about the beginning of December. We finally broke that trend line because folks were getting a little bit more nervous. They were doing a bit more hedging here when it comes to the VIX. Now we're seeing this actually starting to decline. When you look at the bar chart, we're coming down to this green line here, which is just showing that there's not a lot of fear in the market. The Ulcer Index, I stopped showing this in the daily charts or the daily videos because we're pegged right here at the bottom when it comes to fear. This is the weekly chart. We're seeing the same thing on the daily chart. And this was interesting, the Ridex bear bull ratio. Usually this crowd tends to follow what's already happened. But even with the solid update, now there's a day lag here. So this is Thursday's close. We saw a real spike up. Folks were starting to freak out and get out of their bullish funds and get more into their bearish funds. So we tend to use this like the other ones. We follow it as it's going in one general direction. But when it gets to an extreme low reading, that means there's not a lot of fear. When it gets to an extreme high reading, then there is an awful lot of fear. This was updated a few days ago. We had a high reading a week ago above 3 with Investors Intelligence. We've shot up even more, and now we're above 4. This is a pretty high reading. When it gets to a high level like this, this is another one where we start looking at a contrarian viewpoint with this. But this is also interesting too. The American Association of Individual Investors, they usually follow what's already happened too, but they've been declining the last few weeks. We've had some pretty good weeks over the last few weeks, and this is actually coming down. They're not as positive as they were. This is also positive, even though you kind of have to flip it upside down. The black line is when this is going down, that means the tech sector is outperforming cash and we're continuing to decline. Here's some economic things. We are going to get GDP. The third estimate now will be coming out in the upcoming week. We're coming in right at about 2% with what the Atlanta Fed GDP now estimate is. When you look at different analysts, they're coming in at about 2.5% to the upside and just a little bit under 1% to the downside. The takeaway from this is GDP is still positive for right now. If we start to go negative, that brings on the fear of a recession. And we're also looking positive here and looking out into the first quarter that we're getting the estimates for. This is another look at GDP where we see what the consensus is with the black diamonds here. And again, the takeaway from this is that they're positive. And then these gray bars, this is what Goldman Sachs is thinking will happen. This is also the U.S. non-PMI leading earnings indicator. I may show this one in the intermarket analysis video because that's where I go through valuations for the S&P. This is showing some improvement. It's finally crossed back above when they're looking out into the future, showing that earnings still look fairly strong. Then looking at the spread between risky and not as risky bonds, this is getting to a very low reading down here. Again, just looking positive, but maybe looking a little bit too positive. The Chicago financial conditions continue to decline below the black line. We get nervous if we go above the black line. This hasn't been updated since the beginning of February, showing how tightening standards have been lessening in banks. This hasn't been updated since March 5th. we're below the red line. So we get concerned if we go above the red line. And we're also, with this chart, concerned when we're above the red line. We're just barely above the black line. And then this is the Brave Butters. It was updated a little more recently on March 4th, where it's coming down. We were getting a little bit concerned as this was going up, but now that this is pulling back, that's looking a little better. And as I say this periodically with government charts, they're perfect for telling you what you should have done 3 to 6 months after you should have done it. This data is so delayed and takes so long to get to us that this is useful to look at, but it's really hard to make decisions based on this, because what we see happening, we're like 3 months too late when we look at these charts. Here's the latest reading for inflation, and it did bump up when we saw CPI and PPI going up. Now, in this chart, when I show this at the beginning of April, all this will be gone because we'll be starting a new quarter. I think it'll, since we still have 1 week left of March, it'll still continue on another week. Keeping an eye on the Fed. Now the March meeting is now off the table. So now we're focusing at the next meeting, which will be May 1st. And I couldn't believe this. In last week's video, I had 2023 on here. Sorry about that. Just a little bit late. You'd think by now I would have the number of the year correct. But there's an 87.7% chance that at the next meeting, they're going to leave rates where they're at right now. So now the market had been looking possibly at March. It took that off the table. Then it was looking at possibly May. It so far looks like that's taken off the table. Now they're starting to look out at the next chart that I'll show you. And there really hasn't been a big change here. They pretty much are assuming that rates are going to stay the same. This is the June meeting that the market is starting to focus on now. And we're seeing some changes in probabilities here, where most people are thinking when we get that first rate cut, it's likely to be at the June 12th meeting. Now, this is going to change a whole bunch, and it's going to become more firm as we get closer. This is just how the market is feeling right now. There's even 8.9% think that we're going to get a 0.5% cut. And there's about 25% of the folks think that rates are going to stay the same. This shows how things have changed, where this is becoming more solid. And this is looking at a 25 basis point cut. And we've seen that rising recently. We want to keep an eye on the balance sheet. This is where we may get some clues, because as this is going down, that's quantitative tapering. That means they're letting things fall off the balance sheet. If this continues to decline, that's what they're doing right now. If this starts to go back up, that could mean that the Fed is starting to go back in and buy some things. And this is the year over year change, where we're still seeing a lot of things falling off of the balance sheet. Looking at our charts here with the advanced decline line, we're looking pretty solid here, both on the daily charts and on the weekly charts. We're above the moving average based on price and volume. And we're breaking out a little bit. We're coming back up to previous highs based on volume. We're starting to break out based on price. The new highs, new lows looking really solid. When we look at the daily charts, they're also looking good here with our 4-week moving average, even though we're declining a bit with the 10-week moving average. That's because we're seeing a drop off in the new highs. It's not that we're seeing an expansion of new lows. The advanced decline ratio did decline. We saw a little bit below average volume here, but we're still above 0. So this is weakening a little bit, but is still positive. Accumulation distribution above the advancing moving average. And it's also looking pretty solid again on the daily charts. With our trend, the ADX is above the moving average and going up. The green line is on top and is going up, even though that's hard to see. We're a little bit concerned because on the daily charts, the green line is above 40 right now, and that causes a bit of caution. We're still below 40 when we look at the ADX and that's any line. That could be the green line, the black line, or the red line. If any one of those gets above 40, that means that we're getting rather extreme. With the Erin indicator, we're still positive. The oscillator is above 0 and going up. Because the green line is on top, that's buyers, and the red line is coming down, that's sellers. Mass index is not generating a signal. Here's our daily chart, and I tried to crunch this down into 2 years, where this was quite positive. We had been bumping into this daily pivot level, and we're having a really hard time getting above that. We got above it and closed above it, and now we're still above it for right now. So this is shorter term overhead resistance that the market was able to handle. Then we did see a slight change in the decision point scorecard. Their short-term PMO signal has switched to positive after Friday. They're still positive with their trend models. We're still looking negative with their long-term PMO model. We're still looking positive across the board with the Keller market model across all the different indexes. And we're still well above the midpoint and going up with the trend channel going back to 2009. This is the chart that I've probably been focusing on the most, but we're starting to break above this now. We came up to this level back in 2021. That was as far as we went up, and then we spent 2022 really going down. Then in 2023, we came right up to this pivot level and then spent a few months going down. So far, we've been able to stay above this, and this is a weekly chart. So we have 3 bars above this level now, and this is looking more positive. We're also looking positive on a trending basis where price is above the moving average. And when we have the moving average crossover, we continue to be positive with the S&P. We're crossing back above 0 with the McClellan oscillator after we had been below. So that's switching more positive. We're starting to get extreme with the summation index based on price, but it could still go higher. We're above 0 and advancing based on volume. We're looking positive with the Swenlin trading oscillator. We're above 0 based on price and volume. And we're getting extreme, but we're still going up for the time being with the bullish percent index. We're seeing pretty much that same thing with the daily chart. When we top out above 70 and then start to come down, that's where we get a little nervous. But for right now, it's going up. With the PMO, momentum on the weekly charts is still pretty solid. The PMO is going up, but we're coming up to this red line. Now, we could go above that, but this is where we just want to take notice of this. We did advance based on price as well as volume. We did show a bit of a bounce up with the PMOs that are rising. The buy signals are going up. We're going up, but we're getting extreme with the PMOs that are above 0. For 2 days, we saw on the daily chart the percent B indicator flashing an extreme reading. That's because on the daily chart, we closed outside of the upper Bollinger Band, which doesn't happen very often. And when it does, it doesn't stay that way for very long. We're looking more positive here with the weekly chart and not necessarily extreme. Here are our oscillators. We're actually starting to turn down with the slope oscillator. This is shorter term. We're still going up with the TSI. So this is a non-confirmation here. This is a short-term oscillator as well. We're looking good with the MACD, the PMO, and the PPO. They're still positive. That's more intermediate term. And our long-term oscillators are also continuing to go up. So other than the slope oscillator causing a little bit of a concern on the weekly chart, we're positive across the board. We're actually turning more positive with the slope oscillator on the daily charts. The Chaikin money flow, this is still looking solid on the weekly chart. We're actually seeing some weakness on the daily chart. It's coming down, but it hasn't crossed below 0 yet. And this is a smart money indicator. After being extreme positive, we are coming down with the Chaikin oscillator. The force index is green above 0 and still looking positive. We're looking extreme positive with the money flow index. Since we had the up week from 1 week to the next, we were above the midpoint here. Going back 50 weeks, we're above this red line, but we could still go higher than this. We just want to take note when we get above both of these red lines that we're getting rather extreme. Other times, this is where we topped out, right about where we're at now. We are extreme positive with the 14-week RSI. We're not extreme with the daily charts. And we're coming back up, but we're still negative with the special K. We continue to be positive on the daily charts. We're extreme positive with the Stochk RSI. We're extreme positive with the Williams percent R. We're coming down and still extreme with the ultimate oscillator. The vortex, which is showing some weakness on the daily charts, it's floating lower, but it's still positive. We're coming down after getting a really, really high reading here with the green line on this indicator. We're trying to turn positive in the daily charts with the Copic curve. We're still below the moving average here, so we need to see a little more follow through that way. We're well above all of these fib levels and we're above all these moving averages as well. We keep an eye on these if we really start to head lower. We are continuing to go down with the longer term equity put call ratio. When this is going down, that is positive for stocks. We're also starting to turn down when we do a ratio between the VIX and the 3-month average of the VIX. It had been going up. Now it's starting to come back down. With our different charts, we're still looking positive with the Heiken Ashi. We have a whole lot of open candles here. We're positive with the Kegi and pointing up. We're positive with the Renko, and we're positive with the three-line break. And we're seeing that same thing on the daily charts. The ease of movement was pretty much flat, but we're still above zero. So that's looking positive. We had a couple of new X's drawn in here with the point and figure chart, and we actually had that signal taken away. We're still seeing this on the daily chart where it thought we're going up too far too fast. It went away here on the weekly chart. With our momentum, we're looking solid in the long term. We're flattening out in the intermediate term, and we're looking pretty positive in the short term weekly charts here. And I had to adjust this a bunch of times, but now it looks like March 21st was the beginning of a new 50-day cycle. I don't use this to make decisions, but there are times when this marked either a top or a bottom. A lot of times it just marked a continuation of things. And then looking at the Elder's Impulse system, after 2 weeks of being neutral, we've gone back to being positive. The parabolic SAR is positive, and we're seeing that same thing on the daily charts. We are in March here, which tends to be a more positive month than what we went through in January and February. And then just looking at a simple weekly chart of the S&P, which is setting all-time highs, the mid caps, which are setting all-time highs, and the small caps, which are languishing behind. And now you have a lot of folks thinking, well, certainly the small caps are going to kick into gear. Watch the intermarket analysis chart that I do after this. We are seeing some improvement with the small caps, but we're not seeing an awful lot of strength when you compare it to other indexes. The Dow is in a solid uptrend and setting all-time highs. The NASDAQ setting all-time highs in an uptrend. NASDAQ 100 setting recent all-time highs. Here's another weekly chart setting an all-time high. The mid caps, stronger area, setting all-time highs and positive. The small caps haven't been able to break out above previous prices. They are in an uptrend here on the weekly chart. The NYSE setting all-time highs and in an uptrend. All stocks in the US and outside of the US also looking really strong right now. The 30 biggest software companies continue to be in an uptrend. The FANG index did come back and set an all-time high in Friday's session. ARK really is not participating. It's in an uptrend, but we've been seeing this real move up in stocks, and this was up 1.5% on the week. We're keeping an eye on the banks. They're still looking positive. We're going back up with the RSI getting rather extreme. Looking at just the bars itself, this is looking better, and we're still looking positive when we look at the momentum on the weekly chart. And we're still looking good on the daily charts. The bank ETF is not doing too much. It's the regional banks that we're really keeping an eye on. And we're actually, for the first time in quite a while, seeing money going back into banks on a year-over-year basis. Here's just a simple look at Dow theory, breaking all-time highs with the Dow. We're still chopping sideways, so this is a non-confirmation when we compare the Dow with the transports. The utilities continue to be under pressure. The CRB index was up and could be getting ready to show us a golden cross here as well. You would think this would go down if inflation is becoming less of a concern. Oil did try to drop down. It actually closed near the low end for the week, but we still are above 80. Copper is starting to go back up as things are looking a little bit better economically. The dollar is also going back up. We're seeing a potential golden cross on the daily chart. We still have a ways to go here if we keep going up with the weekly chart. Gold broke out. Everybody started talking about it. All the gold people said, this is it. Our party has finally arrived. And then we really didn't see much follow through here. Silver is still in a downtrend, even though it has been going up recently. Keeping an eye on interest rates. We're still looking positive when we look at the total bond ETF. Stocks continue to outperform bonds. We're still positive when we take the 1-month yield and subtract the 3-month yield. And then here's a daily chart looking at yields where they were starting to go back up throughout 2024. Then they were coming down. That's where we got some support. Then they were going up. This was pressuring things. Now they're starting to come back down. Here's a weekly chart looking internationally with the US and UK rates being the highest. German rates are here in blue, and we haven't really seen much of a change here in the Japanese rates. This is a chart that I've been showing. At some point, this may become irrelevant or hopefully replaced by an updated chart. This spike is what we saw last October when the 10-year yield hit 10%, and then we started going down. Other times when we spiked, that usually marks something really bad for the markets. But there's other times we spiked and nothing really seemed to happen. So we're kind of just having to watch this for right now. Also, kind of the same thing here. We got up to a high reading based on real rates. That means they're taking inflation into account and then started to come down. This is when some other bad things happened. So far, bad things haven't happened. Now that could change. Some of the banks could have some problems. Something could happen geopolitically to ruin the parade that the market is currently on. But it hasn't happened. We can't try to speculate on those things. We just have to go with what we see here. We're still up the strongest with oil going back to the beginning of the year, even though it's been coming down. Stocks are in second place, followed by gold, and then the dollar and bonds based on price are still negative on the year. We look at a ratio between the NASDAQ 100 and the S&P, both coming off of all-time highs. They continue to both, or the NASDAQ 100 continues to pretty much outperform the S&P. The S&P 100 continues to outperform the S&P 500. Growth is outperforming value longer term. We want to see this do a little bit stronger. It's holding up okay right now on the daily charts, but we want to see this going up more than it has been. Gold, even though it's coming off of setting all-time highs, it's underperforming the S&P. And it's also coming back down as we saw gold pull back a little bit and the dollar bounce. But we are breaking out above this very long-term trend line going back to 2011. Bonds continue to underperform stocks according to this chart. The low volatility, now if you look at the low volatility ETF by itself, it's in an uptrend. But when you compare it to the S&P 500, it is massively underperforming. Discretionary still outperforming staples. The energy sector, which was starting to show some improvement here, could start to go back down if tech starts to be more aggressive or more strong than energy. And then our longer term chart here, this was the October 2022 low that was set, and then we saw the breadth thrust coming up out of this. And to me, this is indefinitely on the books, and we're still riding the wave of that October 2022 low. The ZWAG NYSE breadth thrust, we're kind of falling off the books. My understanding with this is the signal tends to last for a year, but then we had another one set back in October, so we're still working off of a signal. The Zohorchak method, a very long-term indicator, continues to be pegged at the top. That is a buy signal. And then here's a trend chart going back from the 87 crash. We're above that when we look at the S&P. When we take that same chart and go back to 2017, we're still looking quite solid here above this long-term trend line. We're looking positive here with the NYSE highs minus the new lows. And then this is a 50-period moving average of that. So when we're above zero and advancing, that means longer term, this is positive. The same idea here with the 50-period exponential moving average of the new highs, new lows for the S&P. This is continuing to go up. And when we look at the NASDAQ 100 weekly chart, we're still above this longer-term trend line going back to 2009. We look at this ratio between the NASDAQ 100 and the Dow, we're right about on this line. Are we going to be able to break above it? This is what a lot of the perma bears are focusing on, and they're making all their decisions based on this and some Elliott wave charts that they have to count for themselves, and they often get wrong, in my opinion. But we really haven't seen much of a change here. This is another one we're keeping an eye on, the Qs to the small caps, meaning the NASDAQ 100 of the small caps. It had started to come back down, but as the Qs showed some strength this past week, we're now going back up. Then we look at the NASDAQ cumulative new highs, new lows. After declining for years, they've now started to go back up. That's longer term positive. And then we're keeping an eye on the yield on the 3-month, and it's flattening out for right now. The reason why we watch this is we came up to this level, and this is where we hit in 2007, right before the great financial crisis. We're not seeing that yet, but we still want to keep an eye on this chart. Seasonality, and I try to show some different charts here, where this is, according to Don Bird's chart, we tend to see some weakness going into the middle part of March. Well, we're in the middle part of March now, actually getting a little bit later, and he sees some positive seasonality going into the end of the month. Then this is a chart we've been following for a while. Stocks still seem to be following the same pattern that we saw in 1982, where they came down and then started to go back up. And then this is what happened after that. There was a fairly strong correlation in 2023. We've been going up, and so far we're also following that same general path. Then this is looking at the March statistics from the Stock Traders Almanac, where we're up at 64.9% of the time with an average return of 1.1%. Then this is looking at the election years going back to 1950, where the Dow is up 11 out of 18 times. It's down 7 out of 18 times. Thank you. I really hope you found this helpful. Yes, there are some things that I don't include in this video anymore, but you're going to find those things in the daily video updates. So have a really good weekend, and I will talk to you in the next video.